Hey guys, welcome back. Today let me share with you my Tesla option strategy for December 2022. Now today I'll share with you my thinking framework on how I think when it comes to options and what are the scenarios that can generate me cash flow while I do my options trade. So right now for me, I'm still operating under this framework that there's still a lot of weakness for Tesla's stock price. And later on, I will read you a tweet from Peru Saxena about why the market is going down and S&P is going to 2,800 to 3,000 levels. So right now, let's focus on options, keeping in mind that the market, in my perception, is going downwards and is trending downwards still. So these are the three option strategy I can use when it comes to a downwards market. So the first thing I did for November 29 yesterday is that I sold 100 of my Tesla shares at $185 and I sold a put option at $190, receiving a $14 premiums. This is an experiment I did, selling away 100 of my Tesla shares. Knowing that there's some form of market weakness, I just want to test the market by selling away 100 of my Tesla shares and getting back 18.5k USD in cash. And I sold a put option with a strike price of $190, guaranteeing to buy Tesla stock back at $190. And with that, I received $14 of premiums. $14 times 100 shares is 1.4k. Now, two scenarios will happen. If Tesla goes above 199, then I will start losing money because 185 plus $14 premium, my break even is 199. If Tesla shoots above 199, then I lose money. And this is why I only sell 100 share and sell it during a relief rally so that I can increase my odds of getting a premium for free. Now in the scenario where Tesla crashed, I have to buy them back at $190 per share, but because I received premiums to offset my purchase cost, and the premiums I receive is $14 per share, and these premiums can be used to offset my purchase cost. So 190 minus 14, I'll purchase the shares back at 176 the next month. So this strategy is to risk 100 shares of upside to lower the cost basis of my share price. And I did so with a small portion of my portfolio to test this out if this works. The goal of doing this is to lower my cost basis. Now the second strategy for my Tesla options in this month is to stick to what I'm doing the last month, which is to sell call on my existing Tesla stock, offering my shares as collateral to fund premiums, because I think that there is further weakness coming, and I'll explain this at the end of the video. By offering all my shares as collateral, I can receive premiums just by holding the shares. And if I'm right about this, I'll receive premiums times the amount of shares I hold. So I think that is quite powerful. Even if I'm slightly wrong and I read the market wrongly and my shares get caught away, I can get back cash and I can sell put option back and get back premiums, or I receive back the shares. So it's not a big deal for me if I sell call and sell put, because I'm anticipating weakness from the market, or at least some form of sideways movement. And this is why I did what I did by selling call. If my shares get caught away, I will sell put option to receive them back. Now for this month, I'm not going to be so aggressive on selling call option, which is what I've done the last month. I sold some naked calls and I sold a total 11 contracts of selling call option. Now for this month, I will reduce 5 to 6 contracts, and the reason is for the next option strategy. The last option strategy is to go on short Tesla by buying a few put options for 6 to 9 months, reducing the time decay, focusing on Vega, controlling the efficiency use of capital and no waste dead capital buying put option. So let's say for example, you're 100% long S&P 500 because you're a simple investor, you just want to buy and hold S&P 500. Now let me give you an alternative. You're 100% buy and hold S&P 500 for the long term, but in the short term, the probability of S&P 500 going down 30 to 40% is very, very high. So what I may do in this kind of scenario is to hedge my position. So instead of 100% long, I'll reduce my long to 80% and I'll change the remaining 20% to a short. Instead of 100% long, you are 60% long, you are 20% short. So what this does is you hedge and you become more market neutral. You reduce your bull bias and you hedge on bear bias. So in the scenario, if you are wrong, you reduce your upside and you keep yourself more market neutral so you don't get capital gains. But in the scenario that you are right, because of the high probability and your 20% short generated cash flow for you to buy the stocks that have been plummeted with the 20% profits of cash, you can buy them back at cheaper price and you get exposure to more shares. And you can do that by being flexible and nimble in your mind. Now, let me quickly explain my theoretical options play. Now, let's say for example, you have 1,000 shares at $200. You decided to take profit or cut loss of 200 shares and you hold 800 shares. Now, this 200 shares is converted into cash. Now, this $200 is converted into cash and you decided to use it to buy put or you short the market. So let's say in the scenario that this happens, scenario A happened. So let's say scenario A happened. You really from $200 drop to 160. So there's a $40 drop. So your short profited is $40 times 200 shares times delta, which is the rate of price change minus time decay equals your profit. Now this $200 was converted into, now this $200 times 200 shares was 40,000. Now this $200 times 200 share was 40,000 USD, initially converted to cash. So if you profited from doing this, you will have more excess cash, probably about 65,000. Estimate to buy back the shares at 160 USD. So if you do the math and you divide 65,000 by 160, so you get about 460 shares. So you get about 460 shares of extra going. So what are the risks going from 1,000 to 1,460 shares? So what are the risks associated with going from 1,000 to 1,460 shares potentially? Remember that you initially cut your shares to 800, so you're risking 200 shares to convert them to buy put. So your risk is about 200 shares in potential for additional 460 shares. Now I just want to read you guys this tweet from Peru Saxena. S&P 500 is now trading at 18.3x multiples of 2022 earnings per share of $220. A soft landing means that 2023 EPS is not changed at $220. So there's no recession, there's no contraction of earnings. Even if you give that a 15x multiples given the interest rate scenario now, you'll still get $3,300 for S&P. Now in a scenario of a mild recession, 2023 EPS to decline 15%, you will get to $185 of earnings per share. 15x that multiple, you get 2,775. A severe recession will cause a EPS of decline more than 20%, and that is a $175 EPS. 15x multiples of that is 2,625 for S&P 500. Given the level now, we are at 4,000, so we are not even close and we haven't even feel the full effect yet. And this is why my option strategy is trending towards bearishness, because the analyst is still pricing in 5% growth the next year. Wall Street analyst is still pricing in 5% growth next year, while I'm seeing a decline. I think the decline will have a spillover effect across all industries, and this is why I am net bearish on the market. And I'm trying to use options to hedge my position or short the position, so that the main goal is to increase my Tesla share count and generate cash flow. So this is why I'm doing what I'm doing. Okay, I hope you guys find this useful. I think what I'm about to say is going to be controversial as fuck. Time in the market beats timing the market is correct in theory, but it's used in the wrong practice during 2021. But I'm certain that majority of people should not time the market because they are not taught how to do so. For me personally, I'm young, I want to test out a few things, I want to be guinea pig and go and experience certain things. I like to learn about options and I want to learn how professionals handle their funds. So this is why I have different thinking frameworks and I try to be creative about it and I share with you online. If you understand what I'm saying, you can try and use them on your own and see if it works for you. But always manage your risk. Okay, with that, I really hope that this video helps you out. If I do give this video a thumbs up, subscribe to my channel if you haven't. Thank you and I'll see you next week.